Hi, this is a brief video to show you how to use the Total Cost Analysis module in Mortgage Lens. The Total Cost Analysis module is a module that was designed to allow you to compare up to 3 loans side by side, and the ideal usage of it is to compare the difference in costs over time between the 3 loans whose main differences are the points and the closing costs. So in the current example we have here on the screen, we have a $315,000 mortgage with 6.25 interest rate, a 30-year term, no points up front, $2,000 in closing costs, and a $315,000 loan amount. We're not currently showing any property tax or property insurance, but if you wanted to show a full PITI payment, you could change that, and then of course the PITI payment will reflect those here at the bottom of the screen, but we'll go ahead and put those back at 0. Okay, so this is the first loan, 315, 6.25 with no points. The second loan we have 315, 6 with 1 point. I'm going to change that to 5 and 7/8 because interest rates have gotten a little bit better when you pay points. So this is now 315, 5 and 3/4, 30-year term, 1 point. The cost of point is the $31.50, and we show the same closing costs of $2,000. And then we have the second loan, 315. We're going to change this one also, change it to 5 and 5/8, and we do that by double clicking on the field and entering in the number we want to see. And we have 2 points here, the same 2,000 in closing costs. So the only difference between option 1, option 2, and option 3 is option 2 has 1 point and a slightly lower interest rate than option 1, and option 3 has 2 points and a slightly lower interest rate than both option number 2 and option number 1. So we've entered in the data, and once we've entered in the data, we go to our cost analysis screen by clicking on the cost analysis button, and then we see our cost analysis screen. We see option 1 here with no points, option 2 with 1 point, and option 3 with 2 points. We can move our slider over to month 0, and we see at month 0 the principal interest payment made is 0, no principal, no interest. Balance left is the original balance. The closing costs and points, the difference here in option 2 is we have 1 point more, and option 3 we have 2 points more. And the total cost, of course, again reflects that. Now, because option 2 and option 3 have lower interest, less interest rather, because they have lower interest rates, then over time the cost of the loan, which is calculated by adding the interest paid to the closing cost and point, will eventually be lower than the one with the higher interest rates. And we can see that as we move our slider over to the right. And now we see here that at 36 months, you've now paid $58,000 in interest in option 1. You've only paid $54,400 in option 2 and $52,100 in option 3. This now, the difference in interest has offset that extra that you had to pay in points. So now after 36 months, option 2's total cost, which again is the sum of the interest paid plus the closing costs and points, is now less than option 1. Option 3 is not yet quite caught up. If we move the slider over a little bit more, we can see at 42 months now, option 3 has now turned into the green, which means that it is now less expensive than option 1, which was the no points option. And then we have option 2, which is still better than both option 1 and option 3. And then when we move the slider over a little bit further, we see that at 48 months, we're right at the break-even point, where the total cost savings between option 2 and option 3 is about the same. So in this specific scenario, what you might tell your client is that if they're going to be in the home at least 3 years, if we go back to 36 months, then we see that it would likely make sense for them to pay at least 1 point. And if they're going to stay in the home at least 4 years, it may make sense for them to pay as much as 2 points. So that's one way that you can use the total cost analysis module.